Coming up on today's program, never mind mega cap stocks like the Mag 7, small caps are making some noise, and we'll tell you about one small cap ETF that's outperforming. Plus, we'll examine ETF strategies for income investors in the bond and real estate market. Paul Baiocchi with SS&C ALPS Advisors joins us right after this. Stick around. Welcome to the program. I'm Jaqueline Schadeck. It's great to have you with us. If you're enjoying our original programs, please hit the like and subscribe button. We'll also enjoy seeing your questions and thoughts in the YouTube comment section below. Don't be a stranger. We're pleased to have Paul Baiocchi with SS&C ALPS Advisors. Paul, thank you for joining us.
Good to be here. Nice to meet you, Jacqueline.
Pleasure. As you know, 2024 is on pace to shatter the previous record for active ETF inflows. ALPS has a range of active ETFs, including the ALPS Smith Core Plus Bond ETF, ticker SMTH, which recently crossed $1 billion in AUM in less than a year since launch. What is it about SMTH that has made the strategy so popular, and how would you describe the strategy to advisors?
Well, I think the headline stat around record active ETF inflows informs why SMTH has had such a good year from an inflow perspective. It's kind of drafting on this trend of advisors and allocators getting more comfortable with active ETFs, implementing them more in client strategies, either on a strategic basis or on a tactical basis. And I think when you look at SMTH and our partnership with Smith, we feel strongly that Gibson Smith, the portfolio manager on that strategy, is one of the best bond managers in the country. And so they've had mutual funds in the market for more than half a decade, and launching the ETF version of their Core Plus strategy just allowed for more optionality at the advisor and allocator level. Some advisors prefer the mutual fund wrapper, some advisors prefer the ETF wrapper, and being able to access that portfolio management team's experience, expertise, and portfolio management process in the ETF wrapper has proven to be a very interesting alternative for advisors who are either using alternative fixed income managers in the ETF wrapper or the mutual fund manager and looking for a new emerging fixed income strategy, or advisors who are just reconfiguring at the end of the year into 2025, either rebalancing away from equities towards fixed income, or have sort of been sitting on the sidelines in cash, earning a really healthy coupon on short duration fixed income and are looking to extend duration in anticipation of an extension of the Fed rate hiking cycle. And I think the value proposition for SMTH, like the mutual fund, is you get access to Gibson and Eric Burnham, his lieutenant on the portfolio management side. And what that means is an old school bond management approach. No esoteric product, no swinging for the fences, really trying to provide a ballast in your core fixed income strategy, managing, of course, through various credit cycles, various interest rate cycles, and importantly, managing to pull different levers within the portfolio, whether that be the duration, whether that be exposure to different sectors and segments, and importantly, their bread is buttered by bottom-up fundamental credit research. And that's really what separated them and what they hang their hat on in terms of their process. And so SMTH has been a very popular and very important strategy for us in 2024.
Another active ETF from ALPS is the ALPS Active REIT ETF, ticker REIT. REITs have lagged the market in recent years, but have performed very well over the past few months. What's the case for the REITs going forward, and why should an advisor consider an active strategy like REIT?
Yeah, I think you laid it out really well. There's sort of two pieces to this story. The first is a setup for REITs. And I think when you look at the market backdrop, historically, public REITs have done very well coming out of hiking cycles and at the beginning of easing cycles. The latest example is in the fourth quarter, when the market begun pricing multiple rate cuts into the 2025 calendar, REITs were the best performing sector in the S&P 500. And then you roll over into 2024, you get some hotter than expected inflation prints, the odds of rate cuts go down, and REITs start to lag the market once again. And then as we got toward that first cut, 50 basis points, you started to see rates wake up once again as the market increasingly priced odds of multiple rate cuts in 2025 and beyond. And so The setup from a rate drop perspective is certainly constructive for REITs, or has been historically. I would say when you look at public REITs versus private REITs, they've consistently traded at discounts to net asset values in key categories relative to their private peers. You have a lot of investors, allocators, and advisors who have been in private REIT portfolios, who have been gated in those portfolios and are looking to move back in to a public REIT allocation. Or you have advisors who just haven't had any real estate allocation, REIT, public, private, or otherwise, because they've lagged in this cycle. And given the setup from an interest rate perspective, given the valuation opportunity, and the derivative exposure that REITs give you to AI. I think a lot of people think AI, they think of hyperscalers, they think about large cap growth, specifically in the tech, communication services, and discretionary sectors. But the reality is that these hyperscalers are spending a lot of money to build a data center footprint to support the increased needs from a cloud computing or otherwise perspective, server perspective, for AI and the build out. So REITs are a natural way to play that because the companies that provide those data centers are largely in the public REIT space. I would say taking that piece, the setup for REITs being attractive economically and cyclically, and then adding it to an active conversation, the reality is similar to what I talked about with Gibson. We feel like we have in this partnership access to the best-in-class REIT portfolio managers in the country. GSI Capital was spun out of Green Street, one of the foremost authorities on real estate research. They've taken that expertise, that experience, that valuation framework, and put it into an actively managed ETF that is high conviction. So it tends to have fairly low holdings count, but also allows them to sort of do that sector and valuation work to pick and choose individual names in the public REIT segment that may or may not be large weightings in an index. And I think a lot of people just default in REITs to the Vanguard, the BlackRock, the State Street, basic beta, cheap passive strategy in REITs. And we do think that over time, there is an opportunity to generate alpha, to generate real risk-adjusted outperformance over the benchmark, because when you look at REIT indexes, they tend to have a lot of exposure on a cap-weighted basis to cell towers. And although they have significant exposure to industrials as well, there is opportunity from a relative valuation perspective to pick and choose among those industries within the REIT segment. And the team at GSI, who manage REIT, have done a really good job since inception over 3 years ago of generating really strong relative performance, both to benchmark and to other active strategies in the category.
Understood. Great response. Let's shift gears a little bit and talk about another active strategy that ALPS launched recently, which is the ALPS CoreCommodity Natural Resources ETF, ticker CCNR. How did this product come about, and what are some of the use cases for CCNR?
Yeah, so CCNR is somewhat unique, and there's been this trend in the ETF world of BYOF, as Eric Balchunas at Bloomberg likes to call it, which is bring your own funds. And so CCNR was actually spun out of an existing mutual fund that was in the commodities and natural resources space, and it has a balance between futures exposure and equities exposure. And so what the team at CoreCommodity did was it spun out the equity exposure in the natural resource category and took those assets and put them into this ETF, CCNR. And what CCNR does is it gives you exposure to natural resource equities. Well, what does that mean? It means a mix of commodity-oriented companies in the energy space, in the base metals and minerals space, in the agriculture space, and in the precious metals and minerals space. And if you look at the makeup of the S&P 500, you talked about the Mag 7 at the intro, we talked about the hyperscalers. That index is so dominated by technology, communication services, financial services, as well as consumer discretionary and healthcare. The commodities-oriented segments of that market, energy and materials being two of the most commonly watched, add up to less than 10% of the S&P 500 by weight. So a lot of people, investors, allocators, advisors who are indexed to the S&P 500 are naturally underweight materials and energy companies and a lot of these natural resources companies. And when you look at some of the secular trends at play in the global commodities markets, specifically the energy transition or decarbonization, if you look at the sort of deglobalization efforts from a supply chain or otherwise perspective, a lot of the raw materials that these companies in the natural resources segment are extracting to provide the necessary inputs to build electric vehicles, to improve the energy grid, to ensure that the manufacturing base that we're trying to bring back domestically is built, the data centers, all of the things that we laid out over the course of this conversation. And as we move toward a different form of energy markets, a different form of commodity markets, have these natural resources companies really at the heart of this trend. And so what you get is a globally diversified, actively managed portfolio of natural resource oriented companies, which investors typically have very little exposure to, but also allow you to participate in some of these mega trends that are going to play out not just over the next 5, 10, 15, or 20 years, but over the course of the next 25 to 50 years. And these are companies that are, like I said, extracting so many of these real world materials that are in short supply, and the demand for a number of these products is expected to grow exponentially in some cases. You think about lithium, 30x the expected demand from where we are now. You look at copper demand doubling over the course of the next 10 to 15 years. So a lot of these base materials, a lot of these raw commodities that these companies are going out and finding and extracting around the world are going to be critical components of the modernization of the global economy and the various directions that it's going to take. And CCNR and that team that runs it, CoreCommodity, has tremendous experience navigating these very complicated global marketplace.
Moving on, let's shift to small caps. So despite the 2024 underperformance of small cap stocks versus large cap and Mag 7 stocks, the ALPS O Shares US Small Cap Quality Dividend ETF, ticker OUSM, has delivered strong double-digit results thus far this year. Plus, OUSM has also beaten its peer benchmark, the Russell 2000, over the same period. How do small cap stocks stack up right now, and what makes OUSM an easy way to own this group?
Well, I think there's been frustration on the part of advisors and allocators in small and mid caps, and for good reason. They've effectively gone sideways over the course of the past 5 years in a market where large caps and specifically mega cap technology companies have generated such strong total returns. And so in many ways, you've either seen a lot of advisors and allocators take off their small and mid cap exposure entirely, or just chop it down from what might be a cyclical high. And I think the conversation around small caps right now is largely focused on the Fed. And when you get interest rates cuts, that being positive for small caps. That's not the whole story here. Yes, historically, when you have inflation where it's at, 3% or higher and falling, that's been a good setup for small caps. Typically, when you get to the end of a hiking cycle and the beginning of an easing cycle, that does tend to generate strong relative performance in small caps. But it's not just that sort of economic setup, it's the valuation setup where you see valuation spreads between large and small caps as wide as they've been going back to the dot-com era. You've also now fundamentally got a setup where small caps are expected to grow earnings once again into 2025, either on par in some cases with their large cap counterparts, or in other cases in excess of their large cap counterparts. So you've got this economic cyclicality that has historically favored small caps. You've got this valuation setup, which has historically favored small caps. And then, of course, you've also got that fundamental improvement in the outlook for small caps. But the reality is that you can't always look for history in small caps or other market segments to guide you. The reality is that small caps are a very challenging segment of the market. You've got, at least in the Russell 2000, around 45% or so of those companies by number that are unprofitable. You've got a lot of leverage. You've got a lot of floating rate leverage in that universe. And so the setup for small caps might be attractive, but we feel strongly that just going and using the Russell 2000 or the S&P 600 or the sort of cheap passive beta approach to small caps can be perilous on a go-forward basis, where interest rates are likely to be higher than they've been over the course of the past decade, and those unprofitable companies face a much more challenging economic backdrop. So what OUSM does is it simply takes that small and mid-cap universe and screens down for companies that have higher ROA, so they generate strong profitability, have low net debt to EBITDA, so do that without significant leverage, pay a dividend, grow a dividend, and have dividends that are well covered. And what that translates to, at least in the small and mid-cap universe, is a portfolio that's experienced shallower drawdowns over time, but has also importantly generated really strong risk-adjusted returns. And so the case we're making for OUSM and advisors who are looking at small caps and mid-cap companies once again is that you don't have to resign yourself to the fact that a bunch of these companies don't make money. You can actually use a pretty simple, straightforward, rules-based approach to culling that universe down to companies that do have profits, that do pay dividends, that do grow their dividends and have dividends that are not only well supported by earnings, but importantly, get there without a significant amount of leverage. And on a go-forward basis, given the sort of structural underweight and out of consensus view on small caps, we think the setup for OUSM is really attractive.
Yes, that's some really great points for OUSM. I have one final question for you before you take off. The Alerian Energy Infrastructure ETF, ticker ENFR, has had a strong year, outperforming S&P 500 energy stocks this year. They've also done it in a higher dividend distribution. What's contributed to the success of ENFR, and what types of investors might these ETFs appeal to?
Yeah, so a lot of people know ALPS because of AMLP, which was the first ETF we ever launched. It's our largest ETF by assets, nearly $9 billion in AUM. It's the largest, most liquid MLP-focused ETF. But what a lot of people don't know is we have a sister fund, ENFR, which combines MLPs with C Corps operating in the same industry, energy infrastructure. And what has been so interesting about ENFR so far in 2024, to your point, is that it's outperforming other key categories within the energy sector. It did so last year as well, for that matter. And a lot of that has to do with the nature of these businesses. They're earning fees based on volumes to move, to store, to process crude oil and natural gas. They have a lot of leverage, at least in the case of ENFR, to the natural gas side of the equation. And so when we think about some of these trends, and I know I sound like a broken record here, but you think about the data center footprint that's needed to support AI and all of the investment that hyperscalers are making, well, you need a lot of electricity to support that data center footprint. In addition to that, the energy transition is going to require a lot more electricity as we plug more EVs into garages and into the electric charging network that we're building. Natural gas comes in once again. And then against all of that is a backdrop where we're likely to grow our LNG export capacity by 80% over the next 5 to 7 years, which gives us an additional outlet for that natural gas that gets moved through these networks and liquefied and shipped abroad. And so you've got this near-term opportunity in terms of the stability of the energy infrastructure business, a fee-based model with inflation protections in many of these contracts. And you've also got the secular growth drivers around AI, LNG, global opportunities, and of course, NGLs, which are an adjacency to natural gas production. So a lot of the performance we've seen from ENFR this year, even relative to just MLPs in this space, has been driven by the increasing expectation of demand for natural gas, which is ultimately being produced at record levels in the United States. Record production in the United States of natural gas and crude oil means that you also have really strong volumes through these networks, which is the lifeblood of fees, which is the lifeblood of revenues. And given the fundamental improvements these companies have made over the course of the past 5 years, deleveraging, buying back stocks, and ultimately providing stronger free cash flow than they had historically, ENFR is the cheapest energy infrastructure ETF on the market, is a really compelling opportunity for investors who want exposure to the energy infrastructure industry and want to get some exposure to some of these long-term trends and near-term trends in energy markets.
Well, Paul, thank you for being here. Thank you for your timely insights. Keep up the good work. Be sure to visit alpsfunds.com to learn more about the ETF lineup at SS&C ALPS Advisors. I'm Jaqueline Schadeck with ETF Guide. Thanks for watching. We'll see you again soon.